The Federal Reserve has officially raised interest rates for the seventh and final time this year. The Fed increased its benchmark rate by half a percentage point and signaled more rate hikes ahead in hopes of bringing that inflation down. ABC's Elizabeth Schulze has more on what it means for our wallets.
For American consumers and businesses, the cost of borrowing money is set to get more expensive. The Federal Reserve raising its key interest rate by half a percentage point, the seventh rate hike in a year, as it stays on a mission to fight stubbornly high inflation.
We understand the hardship that high inflation is causing. Data received so far for October and November show a welcome reduction, but it will take substantially more evidence to give confidence that inflation is on a sustained downward path.
Fed policymakers also signaled interest rates will rise more than expected next year. Their goal, to lower prices in the economy by slowing down spending. The Fed's rate hikes this year mean someone carrying a $5,000 balance on a credit card is now paying $1,600 more in interest. A borrower looking to take out a fixed 30-year, $300,000 mortgage will now spend at least $500 more every month than at the start of the year, simply because of higher rates.
Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates.
Despite higher borrowing costs, the American jobs market has been resilient, with the unemployment rate sitting near a 50-year low. Many businesses like Cuzzo's Chicken and Waffles in Michigan are still struggling to hire enough workers.
A lot of the old school methods we would use, just posting a sign or posting an ad, those don't work anymore. You have to make your business somewhere where people want to work.
The big question is if the Fed's moves will tip the economy into a recession. Fed Chairman Jerome Powell says no one knows the answer. Elizabeth Schulze, ABC News, Washington.